3 months ago, a woman named Patricia walked into a mortgage lender's office with a credit score of 621. The loan officer delivered the news she expected. She'd qualify for a mortgage, but the interest rate would be brutal, nearly 7% on a 30-year loan. On a $350,000 home, that rate would cost her over $180,000 more in interest compared to someone with excellent credit. Patricia asked if she could have 90 days to improve her score before locking in the rate. The loan officer smiled politely and said sure, but warned her not to expect miracles. Credit scores move slowly. A few months wouldn't change much. 93 days later, Patricia returned. Her credit score was 761. The loan officer actually asked if she'd submitted the wrong social security number. She hadn't. Patricia had simply learned about a mechanism built into the credit scoring system that most consumers never discover. A mechanism that banks and credit card companies understand perfectly, but have zero incentive to explain. That 140-point jump saved Patricia over $215,000 in lifetime interest on her mortgage. Same house, same income, same person. Different knowledge.
The standard credit advice says pay your bills on time, keep your balances low, don't open too many new accounts, and wait. Wait years, wait decades. Let your credit history age like fine wine. Eventually, your score will climb into excellent territory. This advice isn't wrong. It's just incomplete in a way that benefits lenders enormously. Every month you spend in fair or good credit rather than excellent costs you real money. Higher interest rates on credit cards, worse terms on auto loans, steeper mortgage rates, higher insurance premiums in many states, larger security deposits on apartments. The credit score tax falls heaviest on the people who can least afford it, and the slow conventional path keeps them paying that tax for years longer than necessary. Banks profit from this extended timeline. Someone with a 680 score who could have a 780 score is a more profitable customer. They pay higher rates, they generate more interest revenue. The bank has zero incentive to help them escape that category quickly.
My name is Jude, and today I'm going to show you exactly what Patricia learned, the specific mechanisms built into the credit scoring system that the financial industry understands perfectly but has no incentive to explain. By the end of this video, you'll understand why everything you've been told about building credit slowly over time is technically true but practically misleading. There's a faster path that the system allows but nobody advertises. Subscribe and hit the like button if this ends up being useful. Let's get into it. Your credit score is essentially a statistical prediction of how likely you are to default on a debt within the next 24 months. The algorithm examines your credit history and compares your patterns to millions of other consumers. The single largest factor is payment history. Have you paid your bills on time? This accounts for roughly 35% of your score. The second largest factor is credit utilization. How much of your available credit are you currently using? This accounts for roughly 30%. Here's where it gets interesting. The third largest factor is the length of your credit history. This includes the age of your oldest account, the age of your newest account, and the average age of all accounts. This accounts for roughly 15% of your score. Most people assume length of credit history is simply a function of time. You opened your first card at 18, you're now 30, so you have 12 years of history. Nothing to be done about it. Just wait. But that assumption is wrong, and the error is exactly where the loophole lives.
When you become an authorized user on someone else's credit card account, that account's entire history appears on your credit report. The account's age, payment history, credit limit, and utilization all get imported to your profile, as if you'd been part of that account from the beginning. Read that again, because the implications are significant. If your mother has a credit card she opened 23 years ago with perfect payment history and low utilization, and she adds you as an authorized user today, that 23-year-old account appears on your credit report immediately. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your longest account history could extend by decades. This is exactly what Patricia did. Her mother had 3 credit cards with a combined age of over 40 years, perfect payment history, and utilization under 5%. Patricia became an authorized user on all 3. Within 2 billing cycles, those accounts appeared on her credit reports.
Her thin file suddenly looked robust. Her short history suddenly looked established. Her score jumped 140 points. Marcus was 24 years old with a credit score of 589. He'd made mistakes in college, missed a few payments, maxed out a store card during a rough semester. He was trying to finance a used car, and every dealer quoted him interest rates above 14%. His grandfather had credit cards dating back to 1987. Spotless history, combined limits over $60,000, utilization consistently under 3%. His grandfather added Marcus as an authorized user on his two oldest cards. He never gave Marcus a physical card or access to the accounts. The addition was purely strategic. It took about 10 minutes online. Within 60 days, Marcus's credit report showed accounts with 37 years of perfect payment history. His average account age went from 2 years to nearly 19 years. His available credit tripled. His score jumped to 697, crossing the threshold that qualified him for reasonable auto financing at 6% instead of 14%. On a $25,000 car loan over 5 years, that difference saved Marcus nearly $5,200 in interest. His grandfather's simple action transferred decades of creditworthiness instantly. The question you're probably asking right now, is this actually allowed? Is it legitimate? The answer is unambiguously yes. The authorized user system exists intentionally within credit scoring models. FICO and VantageScore both incorporate authorized user accounts into their calculations. The practice is explicitly legal and officially recognized by all three credit bureaus. Why does the system work this way? Originally, authorized user reporting existed to help spouses build credit. One partner might handle all the finances, opening accounts in their name only. The other partner would have no credit history despite being part of a financially responsible household. Authorized user status solved this problem by letting the credit-building partner share their history. Over time, people realized the mechanism extended beyond spouses. Parents could help children. Anyone could help anyone else. The credit bureau saw no reason to restrict this because it reflects a genuine financial relationship. Some critics have called it a loophole that should be closed. The credit industry has largely ignored those calls. For now, the strategy remains fully operational.
Let me walk through exactly how to execute the strategy effectively, because the details matter. First, the account you're added to must be in good standing. Perfect payment history is ideal. Any missed payments will hurt rather than help. Utilization should be low, ideally under 10%. The account should be old. The credit limit should be high relative to the balance. Second, the primary account holder must be willing to add you. This typically means family members or very close friends. Many people add authorized users without ever giving them a physical card. The addition is purely strategic. Third, not all issuers report authorized user accounts to all three bureaus. American Express, Chase, Bank of America, Capital One, and Discover generally do. Some smaller banks don't. Verify reporting practices before executing the strategy. Fourth, the impact appears within 1 to 2 billing cycles. You don't need to wait months or years. Fifth, you can be removed at any time. This makes the strategy low risk for the primary account holder. If circumstances change, they simply remove you.
The second mechanism most people never discover involves understanding exactly when credit utilization is measured and reported. Your utilization ratio accounts for roughly 30% of your score. The conventional wisdom says keep it under 30%. More sophisticated advice says under 10%. The actual optimal target is between 1% and 3%. But here's what most people don't realize. Utilization is calculated based on the balance reported to credit bureaus, which typically happens on your statement closing date, not your payment due date. You might pay your credit card in full every month, never pay interest, and use your cards responsibly. But if you're charging $2,000 per month on a card with a $3,000 limit and that balance appears on your statement, you're showing 67% utilization. Your score is being penalized even though you pay in full every month. The solution is simple. Pay down your balance before the statement closing date, not just before the due date. If you reduce your balance to $50 before the statement closes, you'll show less than 2% utilization when reported to bureaus. Your score could jump 20 to 40 points almost immediately, simply by changing the timing of your payments. The third mechanism involves credit limit increases and their surprisingly large impact on your score. Utilization is a ratio. You can improve it by reducing the numerator, your balances, or by increasing the denominator, your credit limits. Most people focus exclusively on balances. The limit side of the equation gets ignored. Many credit card issuers offer credit limit increases with no hard inquiry on your credit report. American Express is particularly known for this. You can request an increase through their app or website, and they'll often approve significant limit increases using a soft pull that doesn't affect your score at all. Doubling your credit limit instantly halves your utilization ratio. If you're carrying $2,000 on a $5,000 limit at 40% utilization, getting that limit raised to $10,000 drops you to 20% utilization with zero change in behavior. Your score improves simply because the math changed. The optimal approach is requesting increases on all your cards every 6 to 12 months. Banks rarely advertise this. They prefer keeping you at limits that maintain their profitability. Higher limits mean lower utilization and better scores, which leads to customers qualifying for better rates elsewhere.
The fourth mechanism involves strategic account management that most consumers get completely backwards. Conventional wisdom says closing old accounts hurts your score, so never close anything. This is partially true, but often misapplied. What actually matters is the age of your oldest account and your average account age. Closing a relatively new account might actually help your average account age. Closing your oldest account would definitely hurt. The strategic approach: understand which accounts to keep and which can be closed without damage. That store card you opened 2 years ago to get 15% off a purchase might be worth closing if it's dragging down your average account age and providing no benefit. Meanwhile, your oldest credit card should remain open indefinitely, even if you rarely use it. Keep a small recurring charge on it so it doesn't get closed for inactivity. Many people keep every account open out of fear, accumulating store cards and random accounts that add complexity without benefit. A thoughtful review of which accounts to maintain and which to eliminate can actually optimize your score while simplifying your financial life.
The fifth mechanism is called rapid rescoring, and most consumers don't know it exists. When you're in the middle of a mortgage application, time matters. Improving your score through normal channels takes 1 to 2 billing cycles for changes to appear on your report. Rapid rescoring can update your score within 72 hours. Here's how it works. Your mortgage lender can request that credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance and provide proof. The updated zero balance can be reflected within 72 hours rather than waiting for the next billing cycle. Rapid rescoring isn't available directly to consumers. You can only access it through a lender during an active mortgage application. But knowing it exists lets you time your credit optimization correctly. Make major improvements right before or during your mortgage process, rather than months before when the impact might fade. The combination of strategies executed with rapid rescoring can produce score jumps of 50 to 80 points during the application process itself. Patricia's lender used automated underwriting, which accepted her score at face value. But knowing rapid rescoring exists means you can time your moves precisely. Before I give you the action plan, let me address the 4 mistakes that sabotage these strategies most frequently. First, choosing the wrong authorized user account. An account with high utilization hurts rather than helps. An account with any missed payments in its history imports those negatives alongside the positives. Vet accounts carefully before being added. Second, applying for new credit while executing these strategies. Each hard inquiry temporarily reduces your score by 5 to 10 points. Opening a new account reduces your average account age. People often undermine their optimization efforts by simultaneously opening new accounts that work directly against them. Third, inconsistent timing on utilization management. Paying before statement close works only if you do it consistently. 1 month of high reported utilization can erase months of careful optimization. Set calendar reminders for a few days before each statement closing date. Fourth, impatience. These strategies work within 1 to 2 billing cycles, which feels slow when you're anxious about an upcoming application. People abandon the approach before giving it time to appear on their reports. Trust the timeline and verify changes by pulling your reports after 2 full billing cycles. Here is the action plan based on where you currently stand. If your score is below 650, the authorized user strategy offers the largest potential impact. Identify family members with old accounts, excellent payment history, and high limits. Request to be added as an authorized user on 1 to 3 accounts. Simultaneously, pay down any credit card balances to below 10% of limits before your next statement closes. Check all 3 credit reports for errors and dispute inaccurate items through proper channels. If your score is between 650 and 720, you're in the optimization zone, where multiple small improvements create significant gains. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Consider the authorized user strategy if you have a thin file or short account history. If your score is above 720, you're fine for most purposes, but optimization still matters. The difference between 750 and 780 translates to meaningfully different mortgage rate offers. Focus on utilization timing, limit increases, and maintaining the positive patterns you've already established. Regardless of starting point, pull your free credit reports from all 3 bureaus at annualcreditreport.com and review them for errors. Studies consistently show a meaningful percentage of credit reports contain errors significant enough to affect scores and loan eligibility.
There's a deeper truth underneath all these tactics that changes how you should think about credit scores entirely. The credit scoring system was designed by lenders to predict risk for lenders. It wasn't designed to help you optimize your financial life. It was designed to help banks decide how much to charge you. The system reveals certain information and obscures other information in ways that serve institutional interests over consumer interests. Banks don't explain the authorized user strategy because it helps you escape their high-interest products faster. Credit bureaus don't advertise utilization timing because complexity keeps consumers dependent on credit monitoring services. The entire industry benefits from people believing credit improvement is a slow, mysterious process requiring patience and perhaps paid assistance. The reality is that credit scoring follows mechanical rules. Those rules are knowable. Once known, they can be optimized. The gap between people who understand the rules and people who don't translates directly into lifetime wealth differences. Someone who maintains a 780 score instead of a 680 score will pay dramatically less interest on every mortgage, every car loan, every credit card, and in many states, every insurance premium for decades.
Patricia's 140-point jump in 93 days changed her financial trajectory permanently. The $215,000 she'll save on mortgage interest will fund a significant portion of her retirement. The knowledge she gained applies to every credit decision she'll make for the rest of her life. That same knowledge is now available to you. The loophole isn't hidden because it's illegal or unethical. It's hidden because nobody with a profit motive benefits from you knowing it. The authorized user mechanism is built into the system by design. Utilization timing is simply understanding when the bureaus actually look at your balance. Credit limit increases are available to almost anyone who asks. Rapid rescoring exists for anyone going through a mortgage process. None of it is a scheme. None of it exploits glitches. It's simply operating within the system's actual rules rather than the simplified story told about those rules by institutions that profit from your not knowing them. Same house, same income, same person, $215,000 difference. The only variable was knowledge. You now have it.
If this reframed how you think about credit scores and who the system is actually designed to serve, hit that like button and subscribe. Every week, I break down the financial mechanics that most people encounter too late or never at all. And if you want to understand the bigger picture of how credit score optimization feeds into the 3 net worth levels that change your entire financial life, that video is right there. The credit score is the entry ticket. The net worth milestones are the game. I'll see you in it.